Revenue expense and capital expenditure. So in this introduction, we'll see what is revenue and capital expenditure and how it is important in the preparation of final accounts. We'll also describe what is expenditure and receipts. Those two items we will actually explain. So first, what is revenue and capital expenditure? So as we know, capital and revenue expenditure are very important in the preparation of final accounts. So to recollect, at the end of every financial year, a trial balance is prepared showing debit and credit balances from ledger. And once the trial balance is prepared from it, what is carried forward to the final account is shown again in trading, profit and loss account and the balance sheet. So here we have to note that all expenses and receipts of revenue nature are shown in the trading, profit and loss account, and all expenses and receipts of capital nature are taken to the balance sheet. Hence, it is important to know what is meant by revenue and capital expenses and revenue and capital receipts. Very important in the preparation of final accounts, which are trading, profit and loss account as well as balance sheet. Next, we will see what is expenditure, and then we'll see what is deferred revenue expenditure, and then we'll see also what is receipts. So first, what is expenditure? So here we see what are the nature of expenses, revenue expenses and capital expenditure, effect of capacity of revenue earning, which is on revenue expenses and capital expenses. The differences between capital expenditure and revenue expenditure. So this much we actually try to cover. So first, what is the nature of expenses? So depending upon a number of factors such as nature of expense, benefit from expenditure and effects on revenue earning capacity, an expenditure is termed as capital expenditure or revenue expenditure. So first is nature of expenses. Based upon that, what exactly is revenue expenses and what is capital expenditure? So here revenue expenses are recurring and are of short term. So before we discuss any further, we should recollect what is expense is a short term ordeal, and what is expenditure is an expense incurred in the long term. The difference between expense and expenditure. Also, we have to decide whether the expense is revenue or capital. How do we do that? Any recurring expense such as procuring raw material, payment of rent and salary, telephone charges, etc. are termed as revenue expenses, which are basically recurring expenses. Capital expenditure is similarly on any non-recurring expenditure is capital expenditure, with the exception when materiality concept is applied to recognize a particular expenditure as revenue expenditure. For instance, purchasing of a wall clock for rupees 500 is a non-recurring expense, but application of materiality concept makes it a revenue expenditure. So some of the examples of capital expenditure are purchase of plant and machinery, land and buildings, motor car, etc. So that is based on nature of expenses. Next is based on effect of capacity of revenue earning. How the expenses are determined and what makes revenue expenses and what are capital expenses. So expenses that are incurred in the short term which accrues revenue in the current year, mostly in the current year, is termed as revenue expenses. Example may be purchase of mantle for lamps, which are basically filaments for lamps with expiry of less than 6 months. An expenditure incurred which helps to accrue revenue for more than one accounting period is capital expenditure. So capital expenditure, the example is purchase of plant and machinery. Now the table given here shows the difference between capital expenditure and revenue expenditure. We will just go through it briefly. Capital expenditure is a non-recurring expenditure. It is shown in the balance sheet. Amount spent is usually very large with a purpose to enhance earning capacity of the firm. So this capital expenditure is there with a purpose to enhance earning capacity. Earning capacity is always featured in the case of capital expenditure. Benefit is of long duration. Now, revenue expenditure is recurring. It is shown in profit and loss account. Amount spent is small. Purpose is maintenance of fixed assets, and benefit is of short duration. So this covers the expenditure part of this discussion. Next, we'll see what is deferred revenue expenditure. So sometimes revenue expenditure incurred, the benefit of which may extend to more than the current year. So example might be expenditure for raising a loan or capital or stock issues. Another example is actually an advertising expenditure incurred for the launch of a new product may have benefits accrue immediately but may also spread across the next 2 years. So even though such expenditure is termed capital, what is done is the revenue expenditure in part for the current year will be considered as revenue expense, and the remaining of the expenditure whose benefits may accrue for the next 2 years will be deferred or placed under deferred revenue expenditure or a revenue expenditure that is postponed. So other examples are preliminary expenses, which is for registration or formation of a company, expenditure for raising a loan or capital or stock issues, which is underwriting expenses. So these expenditures are actually termed as deferred revenue expenditure. Next, we'll see what are receipts. So partly revenue, partly capital in the case of sale of assets. So this is where the receipts concept come into picture. So against a supply of goods or services, if there exists a receipt which is related to the period under review, the receipt is termed as revenue receipt. It is usually shown in the income account. Sometimes it so happens that part of a single receipt may be capital and part may be revenue. For example, sale proceeds of an asset. There exist some conditions also for this. That is, if sale proceeds is less than book value, maybe considering depreciation of an asset, the receipt is capital receipt to be reduced from the asset. If sale proceed is more than the book value of an asset but less than the cost of the asset, the receipt is separated under equal to book value of asset termed capital receipt to be reduced from the asset value. Excess is considered revenue receipt. So this completes a discussion on revenue expenses and capital expenditure. Thanks.